Good morning and Happy New Year. My name is Trevor Wilde. I'm the CEO of Wilde Wealth Management Group, and I'm pleased to be presenting our first quarter market update call hosted with myself and Gene Goldman. Before I get into the meat and potatoes of today's call, I would like to take a few minutes just to say a special thank you. First and foremost, I want to say thank you to all of you watching and listening. Our clients have been amazing throughout the last few years, not only getting through COVID and all the things that we had to do from a management standpoint with people working from home and doing Zooms and things like this a little bit more frequently, but more importantly for your support in our organization. Your referrals to our organization are important, and I continue to be amazed at your support of us, and also your support in the efforts that we have in our community. You know, we launched Wilde for Arizona about 5 years ago with the intent to be able to focus and organize not only our efforts as a staff, but efforts throughout our clients and give back into our community. I'm pleased to report that 2022 was a fruitful year as it pertains to how we were able to have an impact on the community. Just to give you a couple quick rundown, our first quarter we had a partnership with Child Crisis Arizona, in which we donated more than 25 fully stacked backpacks for kindergarten age kids and about $5,000 in cash donations that went directly into our community. Q2, we raised more than $2,000 worth of goods and about $3,000 worth of cash donations for Crisis in their efforts. And as we always do, we ended the year with our annual Toys for Tots toy drive, where we successfully donated more than 500 toys and just over $5,000 in cash donations. And I want to say thank you. We couldn't have that kind of impact in our community if it wasn't for you and all of your efforts and support. We look forward to announcing our partnership with different charities this year as we get towards the end of Q1. But thank you for that. Second, I also want to say thank you to our staff, the amazing team of professionals that we have, and our advisors that have just been incredibly resilient, not only through 2022 as we dealt with the volatility of the market and wars in Ukraine, but even the years prior. I can't think of a 3-year period like we've been through. We've never been through anything like this before, and our team has just been amazing. They work tirelessly to improve themselves and to really support ultimately your goals and our goals as your advisor. And I want to say a special thank you to them. So to get back to the meat and potatoes, today's call is a forecast of Q1. Many of you who have been on this call before have heard Gene talk before. Gene Goldman, again, is the Chief Investment Officer and Director of Research for Cetera Investment Research. He's also a good friend of mine. I've known Gene for about 14 years, and I'm proud to call him a friend. And I'd be remiss not to say thank you to Gene. Gene has welcomely donated his time every quarter to do this conference call and to help update all of our clients on different trends that are happening in the economy and things that we need to be thinking about. So Gene, I want to say thank you to you. You know, today's focus will be a little bit about last year, how the market ended, some of the trends that occurred at the tail end of the year, but more of a focus of what to expect in 2023. I know I'm not alone when I say I'm excited to get 22 behind us and focusing on something better and upward in 2023. Gene, thanks again. And with that said, I'm going to turn the time over to Gene Goldman. Gene, take it away.
Well, thanks, Trevor. Well, good day, everyone. Thank you for joining in to the 2023 market update, market outlook. We titled it very simply, Bad News, Then Good News. And I know it sounds a little strange talking about some bad news and good news, but I think the overall gist of what we're thinking about for 2023 is that we'll have some uncertainty, some concerns, a little bit of volatility in the markets in the first part of the year. But then the second part of the year, expect much better things. We're pretty optimistic about how the markets will play out in the second part of the year. So for the next 30 minutes, I'll really discuss two things. Again, the good news going into the second half of the year, but more importantly, why things are going to be tough for the first part of the year. So if we take a step back, let's go back to 2022. And at the beginning of 2022, we laid out 3 investment themes for you. Number 1, economic growth would slow, but remain above pre-pandemic levels. Number 2, the Fed needs to be aggressive. And when I say aggressive, that means raise interest rates to slow down inflation. And we'll talk about that in a second. And number 3, market volatility will jump. Basically, this big swings in the markets that we're seeing right now will likely continue for some time. So those are the themes that played out in 2022. That's what we laid out for you. But with that said, we did see a pretty tough market environment in 2022. For example, the S&P 500, which is a benchmark of US equities, was down about 20%. But it wasn't just stocks. We also saw the worst year on record for 30-year US Treasuries. You know, Treasuries are supposed to be that safe investment, but they were down 33%. And then if you take a 60-40 stock to bond portfolio, which is a traditional sort of in the middle sort of asset allocation portfolio, this fell 24% last year. This was the worst return for this mix since 1930. And in investment grade corporate bonds, good companies, issuing these bonds, they lost about 15%. It's a really tough year for the markets. The only thing that did really well, cash, gold, and oil. Cash is up 1.5%. Oil was up about 0.4%, and then oil was up about 6.7%. So it was a tough environment, despite the fact that our themes panned out last year. So look at this year. This year, we have three broad themes that we think will play out for the entire part of this year. Number one, this market volatility that we're seeing will continue. Number two, the Fed may pause, they may pivot. And I'll talk about, again, the Fed a little bit later, but basically pausing and pivot means instead of continuing to raise rates, they may slow it down, they may stop raising rates, but they actually may pivot and cut rates. We'll talk about what that means later. And number three, upside surprises are very possible. If you think about right now, the economy, everyone's worried about uncertainty in the economy, uncertainty in the stock market, and this may play out. But there comes a point where expectations become so low that all of a sudden these low expectations become easier to beat, and the markets and the economy tends to react favorably. So I'll talk about all that. Again, three market themes for 2023. So let's start with the bad news. And I hate saying bad news. I'm a very optimistic person, but I hate saying bad news. But the bad news is that we do see maybe some difficulty in the first part of the year. Lots of market volatility, but maybe some difficulty for stocks. Maybe, again, maybe. Nothing is guaranteed, but maybe some difficulty. So there's three reasons why we see a potentially difficult first part of the year. Number one, valuations. Valuations in the stock market are lower than they were a year ago, but not consistent with interest rates at 3.5% or with inflation being so high where it is. If you look at this chart, and I apologize, this chart is it's a very couple squiggly lines, but it shows two data points. The purple line shows the PE ratio of the S&P 500. We'll talk about what that means in a second. And the blue line shows inflation. So if you think about my job is the chief investment officer. We look at, are stocks cheap? Are they expensive? And one common measure we look at is called price earnings ratio, the PE ratio. And what this is, it's the price of the stock market divided by the earnings of the stock market. If the number is higher, stocks are theoretically more expensive. If it's lower, stocks are theoretically cheaper. And what you see here is that today, the PE ratio on forward earnings is about 17.5. If you compare that to the average, it's a little bit above the average. And the other good news is that not only is just a little bit above the average, but last year at this time, we saw a PE ratio of around 21 or 22. So it's come down. But the concerning point is those red circles. The last time we saw the PE ratio of the stock market being around these levels, inflation was much lower. Inflation tends to be price multiples, valuations tend to be higher when inflation is lower or when interest rates are lower. But right now, inflation and interest rates are much higher, despite the fact that the PE ratio is where it is right now. All I'm trying to say is that valuations are more attractive than they were last year, but really they aren't really reflecting the high inflation and the higher interest rates that we have built into our economy right now. That's the first issue. Valuations are not great in terms of where they should be. The second reason in terms of a potentially difficult first part of the year is the Fed. The Fed is confusing, and there's this huge risk of a policy error. So let me explain that. And I know we talked about this before, but the Fed is the Federal Reserve. So the Federal Reserve, they're in charge of monetary policy. And really they have two goals. They have two primary mandates. The first mandate is that they want to make sure we all have jobs. They want to maximize employment. The second mandate is that they want to make sure prices are stable. They hate high inflation because if inflation rises, it causes all these other issues in terms of just big issues for the economy. So they want to maximize employment and keep inflation in check. When inflation is rising too high, what the Fed does is that they raise interest rates, then borrowing costs go higher, car loan rates, mortgage rates go higher. This theoretically slows the economy down. When the Fed is thinking that the economy is going too slow, That means we don't all have jobs. The Fed lowers the interest rate. By lowering it, it becomes cheaper to buy a house. It becomes cheaper to buy a car. Again, these are the primary sort of interest rate tools that the Fed has. The Fed has other tools, but those are the things that we really talk about the most. There's raising rates and lowering rates. If you look at this slide, and we know the story. The Fed basically, to address elevated inflation and address the fact that the Fed did not raise rates aggressively in 2021 to combat inflation, it created this what we call a very hawkish Fed. And the hawk is basically as a Fed that wants to really raise rates really fast, really aggressively. And aggressively is what this slide shows. This slide shows that primary interest rate, that big lever the Fed has over the course of time. And when the line moves higher, the Fed is raising rates. When it comes down, the Fed is cutting interest rates. And you see on that second hump from the right, that was the last time the Fed aggressively raised rates. And just to get a perspective in terms of how the Fed is raising rates today, that last rate hike cycle, it took the Fed 3 years to go from 0 in interest rates to 2.25 to 2.5. It took about 3 years. Last year, in terms of getting from 0 to 2.5 to 2.25, it took the Fed about 5 months. So 3 years last time, 5 months this time. So you can see how aggressive the Fed is raising rates right now. Today, the Fed's this Fed interest rate is at 4.25 to 4.5. It's definitely much higher than it was in the middle of last year, or when the Fed started raising rates in March of 2022, when rates were at 0%. The Fed is aggressive; they are raising rates. The problem is that when the Fed raises rates, it creates a greater chance of an economic uncertainty, of a potential recession, because what the Fed is doing is that they're putting the brakes on the economy. And then when they're raising rates even faster than they have before, it really slams on the brakes. And this really is concerning in terms of the Fed, in terms of the economy. So you look at this chart. And this chart is what's called the dot plot. And the dot plot is a cool term. It really means like this. This is a document that the Fed releases once a quarter, and it shows each Fed anonymously where they think interest rate will be, where inflation will be, where the economy will be over the next couple of years and for the long term. And what you've seen here is that red square I have is where the Fed had indicated they expected rates to be back in September. And then the dot plot came out a quarter later, so in December, and you can see the dots have moved higher. All this says in a nutshell is that the Fed, despite the fact that we've gone from 0 to 4.25 to 4.5, the Fed expects, based on this chart, based on what the Fed is saying, they expect rates to go to 5.1% by the end of this year. So if you kind of go through the numbers and so on, this is basically the Fed saying, we plan to raise rates 3 times by 0.25% in the next 3 meetings. So again, today the interest rate for the Fed is 4.25 to 4.5, which is about 4.375. And then you add these 3 rate hikes, puts the Fed in terms of their peak, their maximum rate around 5.1% at year end of this year. But the market doesn't believe the Fed. So again, the Fed says at the end of this year, it'll be 5.1%. The markets don't believe. You look at this slide, it's a bunch of mathematical futures markets, but all it says in a nutshell is that what the markets expect the Fed funds rate, that big interest rate the Fed uses, to be at the end of this year. Right now, it says about 4.6%. So the Fed says we're going to be at 5.1%. The market says we're going to be at 4.6%. There's a big disconnect between the Fed and between the markets. So overall, the markets don't believe the Fed in terms of where the Fed expects rates to be at the end of the year. It's something that we'll watch carefully, because the Fed is going to be more aggressive, but the market's saying you're not going to be more aggressive because of inflation, because of recession worries. You look at this chart. This chart really says it in a nutshell. The bond market don't believe the Fed. So this chart, it plots what's called the 10-year Treasury yield, the 2-year and the 10-year Treasury yield. And we've talked about this before, but just to make sure we're all on the same page, what this is, it shows the yield of the 2-year and the yield of the 10-year. So the yield of the 2-year in bond mathematics, a 2-year yield should be lower than a 10-year, because you're only locking in money in the 2-year yield for 2 years. In the longer term rate, you're locking in rates for 10 years, 2 to 10-year. But what we're seeing right now, and the 2-year should be lower than the 10-year, but what we're seeing now is the opposite. The 2-year is above the 10-year. This is what worries the markets. Because what this says is that, let's say you're a bank, you're a big bank, you're a local bank. You tend to borrow money from us savers at this short-term rate. Then you lend out for mortgages, for car loans, for other loans at this rate. And I know I'm making some assumptions, but you get the point. Short-term rates and long-term rates. If short-term rates are higher than long-term rates, if you're a bank, you're borrowing from you and I as savers, but you're lending out at this rate, you're losing money on every single transaction. If you're a bank, you're like, well, I'm not going to make that much money, so I might as well not lend out as much. And this is what slows the economy down. This is what concerns the economy. So in that 2-year and 10-year, which is called an inverted yield curve, and whenever it goes on this chart here below that horizontal line, it's inverted. The market is saying, Fed, we don't believe you. There's no way you're going to raise rates to say where you have said there will be. The market is saying, we have an inverted yield curve. We don't believe you. Even the Fed is saying, this is going back to the dot plot, the Fed is also saying that the impact of higher interest rates, because remember, rates are moved higher, mortgages are higher, auto loan rates are higher, home equity loan rates are higher. The Fed is even saying, hey, it's going to impact the economy. This is a lot of stuff on this slide. That red circle is important. Back in September, the dot plot, again, this is the dot plot, what the Fed thinks will happen. The dot plot in September said the economy would grow 1.2% for this year. And then in December, it says 0.5%. So really, the Fed has ratcheted down growth for 2023 in terms of, because the rate hikes are impacting the economy. At the end of the day, this is the big issue. The big issue is that the Fed is aggressively raising rates, and there's a good chance it pushes us into a recession. And there's many reasons why that we may see a recession. Again, we're not saying there's definitely a recession. Please don't think that. But there's lots of evidence that we could have a recession. That 2-10 spread I talked about, remember, 2-year, 10-year, becomes less, banks are less incentive to lend out money. If you look at the fact that we have PMIs, and these are these forward-looking data points which have come down pretty quickly. All of them are suggesting that forward data is starting to slow down. Savings rates are at 17-year lows. People are using credit cards more. If you look at this slide, and I know we've talked about PMI before. Remember PMI, Purchasing Managers Index? What this is a survey of purchasing managers. These are the people on the front lines. These are the people that are making those buying decisions, those purchasing managers. I mean, they are purchasing managers. They're in the front lines making those decisions, and they have such access to great information. And what you do, what this company does, ISM, they survey purchasing managers, and they're asked a bunch of qualitative questions. How's business? How's hiring? How's firing? How's competition? How are new orders? And they squeeze it together. Whenever this index is above 50, it's expansionary. Below 50, it's contractionary. And what you see here for new orders, and this is the most forward-looking component of this index, new orders have both fallen dramatically below 50. Basically, new orders are slowing down so much, so fast. Again, a sign of a potential recession coming along. So, okay, again, we're not saying we have a recession. We're not saying we're definitely headed a recession. All we're saying, a recession is possible, and in our opinion, very, very possible. So the question you have to ask yourselves is, if we have a recession, when will it be? And if you kind of look at a couple of data points, we can gauge when we think, if we have a recession, when it would be. And there's 2 data points. First of all, simply, it takes about 12 to 15 months for the Fed's rate hikes. Remember the Fed raising rates? It takes about 12 or 15 months for the Fed, for the economy to feel those rate hikes. So if you think that the Fed started raising rates March of last year, you add 12 to 15 months, you're looking at maybe 2nd or 3rd quarter of this year. Another data point, you look at this slide, this is called the Leading Economic Index. And what this is 10 indicators that are very forward-looking. And they're indicators like average hours manufacturing, jobless claims, new orders, building permits, consumer expectations. And what happens is that these data points are squeezed together to create an index. And why is this so important? Is because this index has a very rock solid track record of predicting recessions. It tends to peak about 13 months in advance of an ensuing recession. And you think about the fact that this LEI has fallen nearly every month since February of last year, you kind of get the expectation that maybe, second, maybe 3rd quarter is when we might see a potential recession. So, bad news at the beginning of the year, we talked about. The first point is valuations are pretty high. relative to relative to inflation and interest rates. Number two is that the Fed, because of their aggressive response to high inflation, is raising rates dramatically, which could create a policy error. And a policy error is basically a recession. The third issue we have to watch carefully is earnings. Okay, so if you think about investing, in Investing 101, what we learned is that if a company is doing well, if the economy is doing well, companies sell more widgets. If they sell more widgets, then earnings grow. If earnings grow, investors tend to buy the stocks of those companies. Really, it's the adage, earnings drive stock prices. And if you think about earnings right now, earnings for 2023, the market expects around $220 for 2023. Is that good? Is that bad? It's okay. But more importantly is the direction. Earnings are only down, have only been revised down by about 4% since the June record high. And if you think about the earnings expectation for 2023, this is embedding a GDP growth of around 4%, some really low interest rates, low inflation. And given the fact that operating leverage tailwinds are starting to reverse for companies, sales volumes are likely to decline if we have a recession, weaker profit margins because of higher costs, labor is still pretty expensive. And this is the kicker, think about this. Inflation from 2022 to 2023, it's starting to roll over. Inflation last year was good for top line growth because companies could raise prices. But now if inflation is starting to roll over, it makes it harder for companies to raise prices, which impacts profit margins. So this slide shows different perspectives of earnings growth. The key point is that FactSet, it's a company that we follow. They create a bunch of data. They're a really big data company. FactSet expects in 2023 their earnings to be about 4% for 2023. Just a few months ago, they expected earnings for 2023 to be about 10%. We do think earnings need to be revised a little bit more because we do think, especially as the markets start to sniff out a potential recession, especially if data starts to slow down, that earnings will start to be revised lower, which could put pressure on stocks. So again, the bad news for the first part of the year, valuations, the Fed potentially putting us into a recession. The third point is earnings. Earnings need to be revised down a little bit more in our opinion. So, okay, that's the bad news. That's the stuff we just want to get. That's the stuff we hate talking about. Let's talk about the good news. And the good news is that we do expect a better second half of the year. And when I say first half and second half, those are not set in stone. It could be like, bad first 4 months of the year and better last 8 months of the year, or bad first 5 months and better second 7 months of the year. Again, it's approximately, but in general, we do think the second part of the year will be better for 3 specific reasons. So number one is that, and something we really spent a lot of time discussing in our 2023 market outlook, is that we start to have a lot of pessimism in the first part of the year. Pessimism pushes down expectations. And when expectations are lower, when people are like, you know what, I'm so pessimistic about the economy, I'm so pessimistic about earnings, those expectations become easier to beat. So if you think about, going back to Economics 101, when economic data exceeds expectations, companies sell more stuff, they generate earnings. Beating expectations is so important for both the economy and for the stock market. If you look at this slide plots what's called the City Economic Surprise Index. And really what this does is that every time a data point exceeds expectations, the line moves higher. Every time it misses expectations, the line moves lower. And you see that when going into a recession and coming out of recession, like that gray bar on the left-hand side, that's a 2008 recession. What you saw is that the data dropped. Expectations were so low. Coming out, expectations were easy to beat, really easy, because expectations were so low, because everyone was so pessimistic. We do envision a scenario that if we have a potential recession in the first part of the year, that people become so pessimistic, expectations are dragged down, and earnings and economic data exceeds expectations much more easily. Again, in other words, lowered expectations are easier to beat. That's the first optimistic reason. The second reason is that inflation, remember the Fed is fighting inflation, inflation could prove to be transitory and a little less persistent. In other words, the Fed could be successful. Remember, the Fed is raising rates to slow down inflation. They're being aggressive. They're trying to rein in inflation. And first of all, taking a step back, why is it so important for the stock market for inflation to roll over? Remember, I talked about valuations. Remember, if inflation is higher, investors want to be compensated with higher valuations. Sorry, the other way around, excuse me. If inflation is high, investors are pessimistic about the future of companies, valuations come down. When inflation is low, valuations come high. I know there's some assumptions in there, but basically, if you look at this chart, and this chart says what I was trying to say, and I apologize for flubbing that, but what this chart says is perfect, that inflation, as measured by CPI, the Consumer Price Index, and the PE ratio of the S&P 500, valuation of the stock market, are inversely correlated. Again, if inflation moves higher, valuations come down. Inflation goes down, valuations go higher. When valuations go higher, stock market tends to move higher. Again, some assumptions there, but long-term, it's important for the Fed to bend inflation in terms of for supporting the stock market. So we know the Fed is fighting inflation. We talked about this. We talked about the Fed is raising rates to trying to slow down inflation. Excuse me. But even with the Fed trying to fight inflation, we're also seeing signs of potential disinflation. So if you think about, inventories at retailers are very bloated. You look at this slide. This slide plots a data point. It plots inventory divided by sales. When there's a lot of inventory on a retailer's, shelves or back in warehouses, the line moves higher. If inventory is rising faster than sales, if sales are rising faster than inventories, the line goes lower. What you see here is that yes, the line has come back down a bit, but inventories are still extremely bloated. This is going to put downward pressure on goods prices, and we're seeing this already. Apparel prices, used car prices, I can rattle off all the stuff. This is going to cause and further cause the retailers to aggressively cut prices. Good news, sales are coming. Look, wait for some sales, more sales. Commodity prices. We all know oil is down, gas is down. Think about it. I live here in California. Okay, don't judge me. I live here in California. So in California, was it like 4, 5, 6, 7 months ago, you would see gas at $7, $8 a gallon. Today, I can see around near me, it's like $4.50 a gallon. Oil and gas prices have come down. But if you check out this slide, something that we tweeted recently, natural gas prices have come down quite dramatically. They have collapsed pretty quickly. All of this, and think about this, natural gas is down about 60% since its August peak. Clear signs of disinflation. This is going to work its way through the inflation indices like CPI, for example. Another thing is that people talk about this all the time, rent. Rent is high, and it makes sense. Think about rent. If you were trying to buy a house and over the last, say, 3, 4 years, it's become super expensive because everyone's trying to buy a house, whether it's working from home, whether it's just moving to a better place away from work. Again, just really upgrading with their living scenario. Everyone's trying to buy homes, but unfortunately, when everyone tries to buy homes, prices move higher, then all of a sudden these home buyers are like, you know what, I'm just going to rent instead. Much more easy to rent. Now they try to rent, and landlords are like, come on in, look at my place. And landlords are raising rent dramatically. This is what we saw for the last few years. But what we're seeing now is something different. Asking rent. This is the rent that landlords are listing on websites. Asking rent is rolling over pretty quickly. My team and I, we went to a website called apartmentlist.com to gather a bunch of data, and you can see that asking rent is falling dramatically. On the far right-hand side, you can see those like 4 straight bars in a row, falling. Rent is starting to roll over. We're not seeing a right now in inflation because it's some, economics mumbo jumbo, how they create the CPI index, but CPI contains rent in it. But eventually this lower asking rent will start to work its way through the CPI report, again, putting downward pressure, helping to create a disinflation perspective for inflation. So first reason is that we see lowered expectations become easier to beat. Second of all, the Fed could do a good job. And actually, we have a disinflation trend helping. So inflation could roll over. This could lead the Fed to not raise rates as much or to actually start to cut rates. The third issue in terms of where we could have a better second half of the year is maybe we don't have a recession at all. Remember, that's still a scenario. We're not saying there's definitely going to be a recession, but there's a chance that we don't have a recession. Keep in mind, the consumer is strong. Capital spending is elevated. Companies are spending money on big, ginormous machines. Loan growth is solid, despite the fact, remember the 210? Companies are still taking out loans. And you take all this together, you look at this chart. This chart plots what's called the Atlanta Fed GDP now. This is basically the Atlanta Fed. It's a subdivision of the Fed, let's just call it that. And they create this real-time indicator where GDP is. Because you think about in my world, we don't get official GDP for like 3 or 4 weeks after the quarter end. It's old data. So the Atlanta Fed said, you know what, let's create this GDP estimate every single day. If you look at this chart, for the fourth quarter, the Fed is saying, we expect GDP to be at 3.9%. It doesn't sound like a recession to me. And plus, even if the economy is headed towards a recession, it's going to take a while to get that down to negative. So maybe there is no recession in 2023. Maybe, okay? That's a positive. But let's just say we have a recession. And, you know, recession sounds scary, but we, at Cetera, we would envision if we have a recession, it's going to be mild for 3 reasons. Number one, the strong labor market. You can look at jobless claims, you go look at the unemployment rates, all this data out here. If you look at this slide, and this slide has a bunch of stuff on here, but it's 2 lines. The purple line shows the number of jobs available. The light blue line shows the number of people looking for jobs. And there's a big spread. There's 4 million more jobs out there than people looking for jobs. Anyone who wants a job can get a job. Anyone that does not want a job can still get a job. There are so many jobs out there. This is a good sign for the economy. Yes, job growth will slow down. It's definitely going to slow down. Fed expects it. We expect it because the Fed is raising rates. This slows down the economy. But we are coming off an extremely strong base that will take a while for a sharp, drastic sell-off in job market for it to impact the economy. So even if we have recession, a strong job market keeps it mild in our opinion. Second reason is housing. I know we talked about this before. Housing is not like it was back in 2008. Remember 2008, housing sold off and dragged us in this huge, steep recession. We don't think that's going to happen this time. And there's many reasons. You know, debt to income is much lower. You know, there's less risk in terms of mortgages out there. You know, you think about this, there's really no balloon payments, teaser rates, all those other funky structural tricks. About 90% of mortgages today are either 15 or 30-year fixed, and they're advertising. All this taken together suggests that delinquencies are extremely low for mortgages. Great news. Also, we have seen weakness in single-family construction, but multifamily construction has been surging dramatically. And then inventories are low. I don't have an inventory chart here, but inventories are extremely low. But probably the most important point in terms of why we see any weakness in housing not driving the economy down is this chart here. This chart shows owner's equity as a percentage of household real estate. What this shows is that on average, and you know, be careful with averages, but on average, homeowners' equity is about 70% of a homeowner's value. So we're not seeing levels back to, since we saw back in the early 80s. What this means is that even when, and likely prices will be impacted, not drastically, but prices will be impacted because there's so much high owner's equity within homes. Even when prices come down, people are not going to be forced to sell. That's good news, because that's what happened in 2008. All those crazy mortgages, you know, no down payment, no income verification, all that bad stuff out there, force people to sell out, force people to sell their mortgages, sell their homes. We just don't envision this right now because homeowners' equity is so much higher. So with that said, again, housing is in the crosshairs of the Fed. The Fed needs to address housing because of inflation concerns. But at the end of the day, we don't see a sharp, drastic pullback in prices, which cause more forced selling. Another reason for potential mild recession, if we have a recession, is that we don't see a broad-based sharp recession. We see like a, I don't know, we call it like a asynchronous recession where only parts of the economy get hit at once. If you think about 2008, remember 2008, everything went down. It was just bad. It was an ugly recession. We envision a recession like this where we're seeing where we're seeing the recession roll through the economy. So you think about today, what's in the recession? Housing, autos, manufacturing. Those 3 areas are clearly in recession. But consumer spending, you know, people are still spending money, people are flying. Energy is okay. Lending is still strong. Capital spending is robust. Companies are still spending money to buy stuff. It's still pretty strong. We do expect a stabilization in housing and autos and manufacturing eventually. And then the other parts of the economy will be hit. So we don't see a big, sharp, steep decline, just kind of pulling down, a little bit pulling down, a little bit pulling down, and then this stabilizes and this goes down a little bit. A rolling and asynchronous recession is what we expect instead. So overall, what this means, it means an economy that's a little bit down, but not in a dire, steep recession. So again, the good news is I talk about on a go forward basis. Actually, let me take a step back. We do expect a tough first part of the year. And tough, I mean market volatility. Will stocks fall dramatically? Maybe, maybe not, but we just expect a ton of market volatility because stocks are expensive, because the Fed could push us into a recession, and because earnings need to be revised lower. But all this creates a better second half scenario because you have lowered expectations. You have the fact that if we have a recession, it's probably going to be mild. And third of all, you just have the fact that, again, lowered expectations, which are really going to, create better data points. So regardless of how tough the first half of the year is versus the second half of the year, keep in mind that the markets are very much of a forward-looking mechanism. So what does that mean? Basically is that they see where things are today, but the stock market looks at what's coming on down the road. The stock market tends to price in events about 6 to 9 months in advance. And so if we do have a tough first part of the year, whether it's volatility or whether it's market or economic uncertainty, there comes a point, even in the most dire situation, where the markets say, there eventually will be a recovery. We need to get into the market before the recovery is priced in the stock market. And what this slide shows, shows historically going into a first year of a recovery, the stock market returns tend to be very strong, whether it's large cap stocks, small cap stocks, growth, or value stocks. Returns tend to be very strong as the market begins to sniff out a recovery. So with all this said, what do? How do you take advantage? How do you kind of be careful in the markets right now? And there's two things, and we've said this before, and we continue to believe this. Number one, be diversified. Diversification is so important. Diversification is a simple investment strategy where you have money in different parts of the market, whether it's large cap, small cap, international, domestic, stocks, and bonds. And I know I talked about this at the beginning, and I said, bonds had a tough year last year. But bonds were down and stocks were down, but that's a very much of a rarity. If you look at this slide, and this slide plots correlation. In other words, how do two things move together, either up or down? If they move together closely, the correlation is higher, the line moves higher. If they move inversely, the line moves lower. What you see here on the far right-hand side, last year we saw extreme correlation between stocks and bonds. It's a very rare event. We very rarely see this. So we still are believers in diversification. We do believe that stocks go up, bonds go down, or bonds go up, stocks go down. Again, we do believe in diversification. So number one, be diversified. Number two is, how do you get diversified appropriately to your long-term objectives? And that's, you need to stay in contact with Wilde Wealth Management and all the advisors. Stay in contact with them because they need to make sure that your portfolio is properly diversified. That's not too aggressive, it's not too conservative, that's lined up to your long-term investment objectives. Stay in contact with them, be on the phone with them, update them with any changes in your financial situation because they need to make sure that your portfolio is perfectly, where possible, aligned to your long-term objectives. So that said, thank you so much. If you want to follow us on Twitter, it's Cetera IM. You can follow me, of course, Gene Goldman on Twitter. I do want to thank you. Again, I didn't want to scare you, but the first part of the year is going to be a little bit sloppy, a little volatile. Second part of the year will be much better from a stock market perspective. Thank you for listening in, and I need to show you these disclosures. I will not read these to you because we'll be here for another 10, 15 minutes, so please read them at your discretion. Thank you so much, and have a wonderful, great day. Happy 2023.
Gene, thanks again for your time. Really appreciate your words of insight today, giving us a little bit more direction on what you're seeing as some of the macro and micro trends in 2023. It's always helpful, and love hearing your input and feedback, so thank you for that. I also want to say thank you to all of you who are watching. I hope you enjoyed today's presentation. As always, if you have any questions, please do not hesitate to reach out to your advisor or any one of us on our team. Our contact information should be coming up on the screen shortly. Also, keep your eyes and ears open. We do have an event in February that we've been doing for about 10 years that we call our forecast event. A little bit more data into the forecast for 2023, where we like to pull some well-known economists about what they're predicting for the year, and then we follow that up with a halftime report in August where we like to track how they actually did. And it's a really fun event that we've done for a long time. Many of you have attended. So keep your eyes and ears open for information coming out about that event next month for February. And as I mentioned at the intro, we will be announcing the charities that we will be supporting this year by the end of Q1. So again, thank you for your continued support in our community involvement, and keep your eyes and ears open for that information coming towards the end of the quarter. With that said, thank you again for your attendance today. Happy New Year, and we look forward to seeing you throughout the course of the year. Goodbye.